And we'll start today with the credit for child dependent care expenses. So this is a non-refundable credit. Again, that means it can reduce your tax, but not below zero. So if you already don't have any tax, you won't get any benefit for the credit for child dependent care expenses. So this is separate from the child tax credit. And if you qualify for this credit, you should fill it out and attach Form 2441 to your tax return. Okay. So there are a few requirements to claim this credit, just like most credits. First is that you must have a qualifying person. And the qualifying person is very similar to a qualifying qualifying dependent. But it includes a child under 13 at that age when the care was provided. So unlike most other age-related provisions in the tax code, this does not look at just the age they were at the end of the year, but the age they were throughout the entire year and when the care was provided. So if your child turned 13 on August 1st, you can claim your child dependent care expenses all the way up from January 1st to July 31st, before their 13th birthday. That child under 13 would have to be somebody that you could claim as a dependent. But besides your dependents, you can also claim as a qualifying person your spouse if they are physically or mentally incapable of self-care and lived with you more than half the year. And so that is a stronger or more stringent requirement than permanently and totally disabled. Disabled means, for tax purposes, that you cannot work or look for work because of a condition. This says you cannot care for yourself. You cannot participate in some of the daily activities of living, like cleaning yourself or cooking for yourself, that kind of thing. And anybody else who is physically or mentally incapable of self-care, who is either your dependent or would have been your dependent except for the fact that their gross income was too high, or would have been your dependent except for the fact that they filed a joint return. So similar to when we talk about medical expense deductions, you can claim deductions for people who aren't your dependents if the only reason they're not your dependents is because they failed one of these two tests, the joint return test or the gross income test. For purposes of divorced and separated parents, the dependent care credit stays with the custodial parent, even if the custodial parent signed the form to allow the other parent to claim the child as a dependent. Okay, so here's our first example. Clara and Tom live together the whole year. Clara pays someone to care for Tom so she can go to work, and Tom is physically unable to care for himself. So Tom is a qualifying person. So we have to specifically mention spouse because, remember, a spouse is never your dependent. Okay. Blair pays someone to care for her son while she works. Eddie turned 13 on August 10th, but while under age 13, Eddie was a qualifying person. Starting on his 13th birthday, he is not a qualifying person. So you can use the expenses paid up through August 9th to figure your credit. Maria is 28 and not mentally able to care for herself. She lives with her brother for more than half the year, and he pays someone to care for her while he works. He supports Maria and can claim her as a dependent. So Maria is a qualifying person because that's his dependent, and she is disabled or physically or mentally incapable of self-care. Okay. Here's where I said that divorced or separated parents, even if the non-custodial parent is claiming the child, only the custodial parent gets to claim the child independent care expenses. Okay. The second test is, so the first test was qualifying person. The second test is the earned income test. In order to claim this credit, you must have earned income. If you are filing a joint return, each spouse must on their own have earned income. So if you have a married couple and only one of the two work, then they don't both have earned income, so they can't claim the child independent care credit. I guess the assumption there is the parent who's not working could watch the children without having to pay something. There is an exception down toward the bottom here about the earned income test, and that what that says is if one of the two spouses is a full-time student or is physically or mentally incapable of self-care, then we add a certain dollar amount to their earned income for purposes of this earned income test. That dollar amount is $250 per month if you have one qualifying person, or $500 per month if you have two or more qualifying people. Bless you. So, if one of the spouses is physically or mentally incapable of self-care for the entire year, then 12 times $250 for one qualifying person comes to $3,000, and 12 times $500 for two or more qualifying people come out to $6,000.
So is that only for spouses?
Yes. Remember, the rule is that both spouses must have earned income. So this is an exception to that rule. So you can add 250 or 500 per month if one of the spouses is a full-time student or disabled. You can only use this rule for each spouse or one of the two spouses in any given month. So if husband graduated in May and then wife decided to go back to school in the fall semester starting in August, you could apply this $250 rule to the husband for the first 5 months and then to the wife for the last 5 months. But if they were both students, you'd have to pick one to apply the $250/$500 rule to. So here's an example. Barbara has a husband, Grant. They pay childcare expenses for their 3-year-old daughter, Susan. Barbara is working as a lab technician. She earned $50,000, and Grant was a full-time student from August to December. Even though he's not working, he's treated as if he had earned income of $1,250. Okay. The third requirement for the child independent care credit is that you must have work-related child care expenses. So this means that you're paying someone to watch your children or other qualifying person because you are working or looking for work. So you can't count expenses for the babysitter while you and your wife go on date night. And number 4, work-related expenses cannot be paid to certain related parties. So they don't count as work-related expenses if you are paying a relative who's your own dependent, or your own child under 19, whether or not they're your dependent, and they cannot be your spouse, and they cannot be the child's other parent. Okay, so paying the child's other parent or having the other parent watch the kids is not babysitting, that's just parenting. And paying them is not a work-related child care expense. So here, Ashley and her son live with her mother, Maddie. Ashley pays Maddie to take care of her 6-year-old son so that she can work. If Maddie is not Ashley's dependent, so Maddie's the grandmother, Ashley's the mother. If Maddie is not Ashley's dependent, Ashley can claim these expenses as child care expenses. And correspondingly, Maddie would have to claim that as income. And the fifth requirement is that if you are married, you must file a joint return. This does not account for head of household because head of household is treated as unmarried. What this basically means is if your filing status is married filing separately, you simply don't get this credit. Yeah, the exception on this slide is all about being counted as head of household. The sixth and final requirement for the child dependent care credit is that you must identify the child care provider with their name, address, and taxpayer identification number. Taxpayer identification number is this umbrella term. It means either a social security number or an employer identification number. It could also be an individual taxpayer identification number for individuals who don't have social security numbers. One exception to the requirement to have the taxpayer identification number is if the provider is a tax-exempt organization, such as a church or a school, you're not required to provide the taxpayer identification number. There's a form actually that you can use to request a child care provider's social security number or EIN, and that's Form W-10. Yeah, most good child care services will send you your end of year invoice saying how much you paid for each child, and their own EIN because they're used to their clients taking the credit.
It's my son's school, and now that I'm doing his class, they're gonna have a school program, so keep track of it all for the parents. I love numbers and I have those books, you know, with the, what are they? Spreadsheets. Yes, I love spreadsheets, and I couldn't even, I can see the pages in front of me. Anyway, it'll be fun.
So here is the top section of Form 2441, and we're on page 324 now. The top part lists all the possible care providers. There's room for 3 of them there, but if you have more than 3 child care providers, you can attach more on a separate piece of paper. And all of your expenses you would list twice, once broken down per provider and once broken down per child. So let's say you have an 8-year-old and a 3-year-old, and you pay $2,000 for the 8-year-old daycare and you pay $4,000 for the 3-year-old daycare, and maybe they went to the same daycare for the first 6 months and then you changed and they went to a different daycare for the last 6 months. So you would list for each provider, you pay each of them $3,000, but then later on, just a little bit lower in the 2441, you would list each child and say $2,000 for this child and $4,000 for this child. This is, I don't know why it's listed as part of the provider identification test, but if you have non-taxable dependent care benefits through your employer, you have to reduce the amount of work-related expenses by the non-taxable part of your dependent care benefits. And that would actually be calculated or worked out on page 2 of Form 2441. Okay, so here's a little flow chart. I know it's hard to read on the screen if the screen is even up. But it's basically going back through all of those 6 requirements that we just listed. Okay, so now if we've determined that you qualify, so again, that is you have a qualifying person who is normally your child under 13, but could be someone else who's disabled. Second, you have earned income. If you're filing joint, your spouse also has earned income. Your expenses are work related. They're paid to qualifying people, not your own dependents or certain relatives. You're not married filing separately, and you have your provider's information. Then we can actually start to figure out what your credit is. And the credit is based on your work-related expenses. So first thing to do is you add up your work-related child and dependent care expenses. And there are certain expenses that don't count. So educational expenses for someone who is kindergarten age or older don't count as childcare expenses. So in this example, Claudia has a child who attends first grade at a private school. The tuition for the private school is not a childcare expense. But if the child goes to an after-school program at a childcare center, that after-school care is counted as childcare expenses. However, the younger child who is not yet kindergarten age, so basically 4 years old or younger, that is considered primarily childcare, even if there is some educational motivation or activity going on with it. Okay. So after you add up all of your work-related expenses, you're going to come up with a dollar figure, whether it could be anywhere from $2,000 to $10,000 to $20,000, or doesn't matter, but you're going to come up with some number for your actual expenses, and then you're going to compare 3 other numbers. You're going to look at your earned income. If you're married filing jointly, you're going to look at the other spouse's earned income. And finally, you'll have a flat dollar amount, which is $3,000 if you have one qualifying person, or $6,000 if you have 2 or more qualifying people. Out of those 4 numbers, the smallest one is your overall work-related expenses. And remember, the dollar limit will have to be reduced by any tax-free dependent care benefits you receive. So here's an example. Barbara and her husband Grant have child care expenses of $4,500 for their 3-year-old daughter, so that Barbara could work. She earned $50,000. Grant did not work, but was a full-time student from August to December. So under the full-time student rule, we can treat Grant as having $250 per month of earned income times 5 months. And then we have a flat dollar limit of $3,000 because there's one qualifying person. So actual expenses is $4,500. Then Barbara's earned income is $50,000. Then we have grants, earned income, which is 1,250 under the special rule for students, and flat dollar amount for one qualifying person is 3,000. So out of all four of these numbers, we have to pick the smallest to be their work-related childcare expenses.
Grant income.
Yeah. So 1,250 is the lowest of all of those four numbers. So we'll do the rest of the childcare expenses for this couple based on 1,250. Okay. So part two of the 2441 lists the dependents or the children being watched or the disabled, the qualifying people being watched, and part one lists the providers. And the total should be the same for each. You can also, you might have a qualifying person for whom you have no expenses. And you might want to do that because if you have a second qualifying person, that flat dollar amount goes to 6,000 instead of 3,000. So you may have a relatively mature 11-year-old who is pretty good at not answering the door when they're home alone, and so you don't pay anyone to watch him. But then you have your 7-year-old who does go to childcare, and it costs more or 6,000 or more. You have two qualifying people, even though all of your expenses are going toward the younger child. So you can claim up to $6,000 in expenses. So here, Shane has two qualifying people. He pays 2,000 for one and 4,700 for the other. So that total is 6,000 altogether. It's not like 3,000 per person. So even though it's not equally divided, he can claim up to 6,000 in expenses for the two qualifying people. And here's our example of a qualifying person with no expenses. Okay, here's an example of Form 2441 that is reproduced on page 327 of your return, of your textbook. There's page 1 and page 2 is for calculating the non-taxable part of your dependent care benefits, but then also reducing the amount that's available for the credit. We won't talk too much about the exclusion from dependent care benefits today, but we will work a little bit more on the child and dependent care credit. Okay. If your child care provider refuses to provide their name or social security or your social security number or employer identification number, as long as you made a sincere effort to get that, like you gave them the W-10, you pointed out that they could be fined for not giving that information, and they still refuse, then you can still claim this credit, but you have to be able to document the efforts you made toward getting that number, and you'll end up having to mail your return to the IRS instead of electronically filing it. Another option is you could e-file your return without claiming this credit and then mail an amendment with the credit later on. Okay, so let's finish off this example. So we have Barbara and Grant. They have 1,250 in eligible expenses. And then the next thing to do is it's helpfully pre-printed on the form itself. We multiply that amount by a percentage figure based on their adjusted gross income, which I can't read that at this distance. So let's see.
1250 the on line 6.
Hmm?
What line is on?
It's on line 8. Or Yeah, so we take their adjusted gross income. So in this example, their only income is going to be Barbara's $50,000. So 50,000 is their adjusted gross income. We look that up in the chart and we find that that's over 43,000. So they're in the highest bracket for child and dependent care credit purposes. So their credit amount is 20%. So, um, so eligible expenses is the minimum of these four values. And then we'll have a credit rate, which we looked up on the form, which was 0.2. And so their actual child and dependent care credit is 1250 times 0.2, which is $250.
Wow, not much.
No. Okay, that's all I really need to say on child dependent care credit.